Welcome to the Mortgage Rate Weekly Market Update for the week of January 8th, 2018. Hello, I'm John Thomas with Prime Residential Mortgage. Here to give you an update. Well, last week, mortgage rates did move slightly higher. If you take a look at the bond chart on the screen, you can see mortgage bonds had rallied off a floor of support about mid-December, moving interest rates lower until right before the new year. They hit a ceiling of resistance and were not able to break above that. So you can see that blue line there. That's the ceiling of resistance. And then there's a floor of support. So the bond had traded between those 2 points last week. So you can see on Tuesday, we were in the middle of the range. We were able to rally on Wednesday above that ceiling of resistance, but then on Thursday, we couldn't follow through. We fell back below it and then sold off again on Friday after the jobs report. So we did end right at the bottom of that trading channel, right above support. So we're going to recommend floating your mortgage rate to see if mortgage bonds can rally off support. If the bonds move higher, that'll move interest rates lower. Now, if they break below that floor of support, we're going to quickly recommend locking in because there's a long way the bond could fall, which would move interest rates higher. Now, if we dig into the economic news, the big report last week was the December 2017 jobs report. We were expecting 185,000 jobs created. We only had 148,000 jobs created. So that was a miss on the jobs report. The unemployment rate remained the same at 4.1%. Now the U6 unemployment rate number, which measures total unemployment, moved up from 8 to 8.1%. And then the average hourly earnings were only up 2.5% year over year. It's the same as last month. So what that means is there's no wage pressure inflation. So inflation is bad for bonds. So that is good news for bonds, even though the bond did sell off because the stock market rallied, set another record high. It's still a supporting thing that we don't have wage pressure growth because that would mean inflation, which would definitely be bad for bonds. Then on Thursday, we saw weekly initial jobless claims come out. They moved up 3,000 claims to 250,000 claims for the week. That's the highest since October 2017, but it's still well below the 300,000 mark, which signals bad labor market. So we're still got a good labor market. So even though we did tick up slightly on the initial jobless claims, still very good, healthy labor market there. Now in housing news, we saw pending home sales come out for December 2017. They were up 0.2%, and the index was at 109.50, which is the highest in 6 months. Pending home sales were up 0.8% from December 2016 to December 2017. Remember, pending home sales measures the number of new contracts on existing homes for sale. So that points to a very good existing home sale market moving into the winter months. Then we saw CoreLogic release their home price index for November 2017, which showed home prices were up 7%. They were up 1% from October to November, and they're up 7% year over year from November 2016 to November 2017. Now looking forward, CoreLogic is predicting home prices on average to increase 4.2% year over year from November this year, or 17 to November 2018. So that, again, points to a very strong housing market. The big influence factor there is low inventory is going to continue, which is going to continue to push home prices higher. Then some big news on mortgage credit certificates, which are also nicknamed first-time homebuyer tax credits. In the tax bill, the House version was going to eliminate mortgage credit certificates, so they were going to go away. But the final tax bill that passed, it did save the mortgage credit certificates. So if you're a first-time home buyer, you are still eligible for the first-time home buyer tax credit program, which state by state it can be different. For example, Delaware gives you a tax credit of 35% of the interest you paid on your mortgage for the year, capped at $2,000. State of Maryland gives you 25% of the interest you paid for the year, capped at $2,000. So if you enroll in the program and get a mortgage credit certificate, you can get a tax credit up to $2,000 every single year that you have the mortgage, and that was saved. So those are business as usual now. In the local news, we've got the next first-time homebuyer seminar this Wednesday in Wilmington, Delaware, from 6 p.m. to 8 p.m. So that's January 10th. That's at Independence Mall off Route 202. And then the next one in Newark is Saturday, January 20th from 10 a.m. to noon at the Christiana Hilton Hotel in Newark, Delaware. You can register either one of those events by giving us a call in the office at 302-703-0727 or online, www.delawarehomebuyerseminar.com. Look forward to seeing you guys next week.